Our starting point was this first cut classification. You should always be crystal clear that am I talking about hedging or speculation or arbitrage. There are three very different activities. Hedging is when you have some risk, you want to get rid of it. Speculation is when you have a forecast about the future. You believe that gold prices are going to go up or Nifty is going to go down. If you want to exploit those forecasts, that is speculation. Arbitrage is really either deploying money in the market to get above market rate of return or loaning out securities or gold into the market to earn some good rate of return. So there are three completely distinct activities, and you should always be crystal clear that right now are we discussing a hedging strategy or a speculative strategy, and so on. Okay. Now hedging for a stock speculator. Now that's a very nice piece of schizophrenia which we should ponder. You are a stock speculator. You see, part of your mind, with half of your mind, you are a stock speculator. You are saying, I believe that interest rates will go up. That's a speculative statement. You want to harness that view. You want to make money because you have a forecast that interest rates will go up. But in that, you have a problem. Because if you just go to NSE and buy shares of Infosys, you have a problem that your entire position might go wrong because Nifty might collapse. Something else could go wrong. There's nothing wrong about your core view. You might have been right in saying that Infosys is likely to go up, but you might go wrong because Nifty goes down. So you would like to hedge away your Nifty exposure. Okay, we call that being focused in your bet. Are you buying Infosys because you believe Infosys is going to go up, or are you buying Infosys because you believe Nifty was going to go up? Okay, you have to make up your mind. If you believe that you are buying Infosys because you think Infosys will go up, then the fluctuations of Nifty are just a nuisance, and it's good for you to get rid of them. So the strategy is that you should be simultaneously taking a short position on Nifty, so that you are long Infosys plus short Nifty. The short Nifty part gets rid of the Nifty exposure. So you have a focused bet that your net position, which is long Infosys plus short Nifty, is only a bet on Infosys. Whether the BJP government falls or Nifty does very well or whatever will not affect the profits from that position. But if there is good news or bad news about Infosys, that position will be affected. So it becomes a more focused play on the information about one company. Okay, so this is a classic application of the index futures. So if you are a speculator on a stock, but you are a hedger when it comes to the index, because you have a view about Infosys or you have a view about ITC. Okay, now to do this right, you do need this concept which is called beta. Okay, the example was that Lupin Lab has a beta of 1.2. Now I am a speculator on Lupin Lab. I have an interest in Lupin Lab, so I buy 1 million rupees of Lupin Lab. Hiding inside that, in some sense, I have 1.2 million rupees of a Nifty exposure. So if I want to strip out my Nifty exposure, my net position will be long 1 million rupees of Lupin Lab plus short 1.2 million rupees of Nifty. The overall position will be neutral to the index. Whether the index goes up or the index goes down, I will not be affected. My position is only a play on Lupin Lab. Okay, so that's the role of beta, that you need to measure the sensitivity. If you had a stock which was really not very sensitive to Nifty, you would need to short sell a smaller amount of Nifty. Okay, so this slide works through every step of the story. I am long Lupin Lab for 200,000 rupees. The beta is 1.2, so I really want to sell 240,000 rupees of Nifty. Now I go to the futures market. On the futures market, I see there is some Nifty futures contract which is running at a price of 1150, but the market has a market lot of 100. So I can trade in 100 or 200 or 300, but I can't trade in any number that I want. So the closest that I can get is 200, because when I short 200 Nifties, I get a position of 230,000 rupees, which is the closest possible to 240,000 rupees. So overall, I am long Lupin Lab 200,000 rupees, short Nifty 230,000 rupees. That's the best hedging that I can do. It substantially eliminates my index exposure. It doesn't completely eliminate it, but that's okay. It's really a small problem. Okay, so this kind of what we call complete hedging, it requires a knowledge of beta. As usual, you can go to the NSE website and get beta tables, or you can calculate betas yourself. And I always like to keep reminding people that it's not that big an issue, in the sense that if you don't know anything about the stock, it's safe to think that the beta is roughly 1. Okay, the analogy I always give people is that when you have no hedging, when you come from a world with no hedging, which is what all of us have in India today, and into that we start doing some imperfect hedging using a rough estimate like beta equals 1. That's okay, you're still much better off than what you used to be before. Then on top of that, you can start becoming more perfect. You can start trying to refine your beta estimates more accurately. You can get into debates like beta change, do I need daily data, do I need weekly data. In my humble opinion, all that comes next. The first goal that all of you should be applying is that let's solve the first order problem. The first order problem is that right now there is no hedging in India. People who speculate on stock do so nakedly, and that's very inefficient. Okay, then the question comes, can I quantify my reduction in risk? That's what brings us to this neat little formula saying that the variance of returns is beta squared times the variance of Nifty plus the variance of epsilon. That beta squared variance of Nifty, that component can be eliminated when you do complete hedging using the futures market. So you will be left with the variance of epsilon. So you will be left with a pure bet on the stock specific news. You will have eliminated the index fluctuations. Okay. Now the opposite of that is when you are short a stock. So far I was always saying that I am buying Infosys, so to compensate I am shorting Nifty to eliminate my Nifty exposure. But I can equally do this upside down. Suppose I am shorting ITC, suppose I am selling ITC on the market. Now I have a fear that what if Nifty goes up? You see, that's my fear. That if I have sold ITC on the market, why have I sold ITC on the market? It's because I have a bet that ITC will go down. But what if the overall market index goes up by 10%? Then ITC will also go up. And I will stand to lose a lot of money. Not because I was wrong on ITC, but because the overall market index moved so much. So I need to protect myself against that. So how do I do that? My overall position is short ITC plus long Nifty. The long Nifty position will make money if the market index goes up. That is what will compensate me for the losses I will take on my ITC position. Okay, it's the same principle. Long ITC plus short Nifty, short ITC plus long Nifty. These are hedged positions where you get a focused bet which is only a bet about the future of ITC and which is immune to whatever happens to Nifty, which is not the subject of your bet. Okay, all that was stock level speculation hedging against Nifty. Okay, so in all this, be very clear who we are. In all these examples so far, I was saying that you are a speculator on ITC or you were a speculator on Nifty. If you believe that ITC is going to go up or that Infosys is going to go down and you had adopted certain speculative positions on the stock market. How do you reduce the risk of those positions? How do you get a more focused bet? Okay, now I turn to the next kind of application. This is also a very mainstream application, but it's a hedging application. Let's see what happens. Here you have a portfolio, okay, which is actually something which most of you will immediately wipe this, even if you don't personally do active speculation on the stock market. In this example, you have a portfolio and every portfolio in India contains Nifty exposure. If Nifty goes down by 10%, their portfolio is bound to suffer. This happens to every single portfolio in India. Okay, now for the next 1 month, 2 months, you become uncomfortable for whatever reason about the future stock market volatility. Why might you become uncomfortable? You might become uncomfortable for 2 reasons. One is that you might be needing the money. You might think that 2 months from now I'm going to sell these shares, I need to buy a house, whatever. You might have some plans of utilizing that money. So you become more uncomfortable if there's a drop in the share prices. Or you might become uncomfortable because you think that the stock market is going to be very volatile, there might be uncertainty on the market and so on. So you might become uncomfortable because you expect that there is going to be a lot of volatility in the market. Be that as it may, if you become worried about the money that you would lose when Nifty drops, there is something you can do about it once there is an index futures market. What you could do is, you could short sell Nifty. Okay? What is short sell Nifty? When you sell the Nifty futures, you get paid if Nifty goes down. Okay? Note, you also lose if Nifty goes up. It's an upside down position. So now I have a portfolio plus I short sell Nifty. Now if Nifty drops, I lose on my portfolio, but I get paid on my short position on Nifty. You get it? Okay? Is that a fair idea? So it compensates you that you have a portfolio which loses money when Nifty goes down, but you get paid by a short position on Nifty, where a decline in the index generates a revenue in your hand. Okay? But note that the short Nifty position will actually take away your upside. If the index goes up, the short Nifty position will lose money. Again, we call this hedging. You're not speculating. You're hedging, that you have a portfolio and you've shorted Nifty. Now you're neutral. But the Nifty goes up and Nifty goes down, you're relatively immune. So that's what you will do when you want to get rid of your risk. You're not being a speculator. You don't have a bet on whether Nifty will go up or Nifty will go down. You're just saying, look, I'm not interested, I don't want this risk. For the next few weeks, let's get rid of this risk for me. Okay? So that's what you're doing here, that I have a portfolio and I want to get rid of the risk. That is, take your portfolio, leave it unchanged, supplement that with a short position on the Nifty futures market, and you will get a hedged position. Once again, let's work it out numerically. Suppose I have a portfolio of 3 lakh rupees, 300,000 rupees, and suppose your beta is 1.2. So now ideally, you would like to be shorting 360,000 rupees of Nifty. Okay? Beta multiplied by the Nifty, the portfolio value. Now suppose you go to the Nifty futures market and you observe that the product, the Nifty futures product, has a cost of 1150 rupees. Okay? Now the market lot is 100. So you can buy and sell 100 futures, 200 futures, 300 futures, but you can't do anything else in between. So the closest that you can get is 300 nifties. Okay, if you do only 200, you will be at 230,000. If you do 400, you will be at 460,000. So 300 is a nice place because you come in closest. So you will short sell 300 nifties, which is a position of 345,000, which is close to 360,000. It's not perfect, but it's okay. It takes care of the bulk of your risk. Okay, so your overall position will be that you have a portfolio of 200,000 rupees and you have shorted nifty 300 nifties adding up to 345,000 rupees, which gives you a rough hedge that you will effectively be immune. Whether nifty goes up or nifty goes down, the overall profit and loss in that position will be roughly zero. Okay, why would you do this? It's because you don't like that risk. Okay, so you have to ask yourself that have you ever found yourself in a situation where you have a portfolio and you just don't feel like bearing this risk for the next few weeks? Okay, then this would be an appealing strategy. Once again, in this also, just like in the stock case, you need to know the portfolio beta. Okay, now how do you calculate portfolio beta? If you know the individual stock betas, then the portfolio beta is just a weighted average of the stock betas. Okay, here I have an example. Suppose the beta of Reliance is 1.4 and suppose the beta of Hindustan Lever is 0.8. Okay, and suppose I have a portfolio where I have 1 rupee of Reliance and 2 rupees of Hindustan Lever. Okay, then my overall portfolio beta is 1 into 1.4 plus 2 into 0.8 whole divided by 3, which works out to 1. Okay, so it's very easy to calculate a portfolio beta once you have individual security betas. So once again, you can go to NSE, get the beta table from that, then make a weighted average of all the stocks in your portfolio, and you can make a portfolio beta. And once again, if you don't know anything about a portfolio and you just want a rough approximation, the rough approximation is 1. It's always safe to think that your portfolio's beta is roughly 1. Now, there is one interesting difference between what we have done earlier in terms of hedging for a stock speculator versus what I'm talking just now, which is hedging for a portfolio owner. The difference is this, that in a stock, when you talk about one stock at a time, the overall risk of the stock is broken up into 2 parts. There is the market index related risk, that is really the nifty exposure, and then there is the stock specific risk. Okay, and the stock specific risk is fairly large for any individual stock. The beauty of a portfolio is that by the time you're talking about an entire portfolio, the portfolio diversification itself serves to cancel out a lot of the stock specific risk. So by the time you're looking at portfolios and not at individual stocks, actually the bulk of the risk of the portfolio is entirely in the nifty. So if you really get to doing hedging against a portfolio, you can take away the bulk of the risk of the portfolio using the futures. Okay, and it's really quite remarkable. So as a thumb rule, I say that for small cap stocks, if I start hedging away using nifty futures, I can get rid of 20%, 30%, 40% of the risk, which is not a very big number, but it's still better than nothing. So if I take an individual small cap stock and I get rid of my risk using the nifty futures, I might have got rid of 1/3 of my risk. Okay, then I take a stock like ITC, I can get rid of maybe half of my risk or sometimes even 2/3 of my risk by hedging using nifty futures. But by the time I come to large portfolios, I have a portfolio of 10 stocks, portfolio of 20 stocks, it is common to see 80% of the risk being just in the nifty. And that's very exciting because I'm saying that if you have a full portfolio and you become uncomfortable about your level of risk and you start hedging using the futures, you can probably take away 80%, 90% of the risk of your overall portfolio by hedging using the index futures. So the gains from hedging for small individual stock owners is there, but the gains for hedging are even greater by the time you talk portfolios. Okay, so that's because the unsystematic risk has been eliminated by portfolio diversification in the first place. Okay, now in this you will come to me and you will say, why didn't I do like this? But I have my portfolio, I have 1 million rupees of shares and my portfolio has a beta of 1. So I want to short sell 1 million rupees of the nifty futures. So my net risk is roughly 0. So should I do that? I'll just keep on shorting 1 million rupees of nifty futures. I'll do that for years and years. Then I will not take any risk. Is that a good idea? Okay. The answer is no, not really, and here's why. The fundamental argument, why do we own stocks? Why is it worth owning stocks? Because in the long run, stocks earn higher returns than bonds, and you pay for that by paying a higher volatility. Okay, so shares are greater risk and greater return over long periods, over decades. In every single horizon of 1 decade or more in Indian history, you find that shares have performed very well. And this is true not just for India, it's true for all over the world. the long run average rate of return on Nifty is around 20% when you include dividends, which is a very nice rate of return. But you do have to pay the day-to-day volatility in order to get that return. You don't get it risk-free. If you don't want to take any risk, you'll be getting the National Savings Certificate rate of return. Now, if you hedge using index futures, you're actually eliminating your stock ownership in a very real sense. But if you bring down your beta to 0, the month you are at a beta of 0, you're like a treasury bill. You'll get a return like a treasury bill. Okay, so over long horizons, if you hedge away using index futures, it's as if you have never owned equities in the first place. That doesn't make sense. So hedging using index futures should be recommended for short periods. The best example is if you are going to need the money within a few months. Okay, then you say to yourself, look, in the long run I'm okay, but in the next few months I really cannot afford to take these risks. So for the next few months I don't want to take chances. I want to eliminate my risk. So for the next few months, let me hedge. That's a perfect situation when you should be looking at index futures. Or you might say, there's a lot of volatility in the next few weeks because this government is going to come, there's going to be elections. I don't have an appetite for this volatility. So let me sit out the game for the next 4 months. That's a fair statement. So you can hedge using index futures, stay out of the game for the next 4 months. Once a new government falls into place, stock market volatility will come down, then you can come back in by getting rid of the futures position. That's also fair, that's defensible. But if you start shorting index futures, try to get rid of your entire risk and keep on doing this for years and years, that doesn't make sense. You'll actually be better off by just selling off your shares and staying out of the stock market altogether. Okay, so you should use derivatives for short dated, a few weeks, a few months max. A single position should not be held on for years and years. That doesn't make much sense. Okay, now here's another kind of hedging. What if you have money on your hands, or you are thinking that you will get some money in the future? Okay, and you're thinking that I'm going to use this money to buy shares. Okay, so one standard example, as I have in the slide, is that I've contracted to sell some land. Now we all know that the land market doesn't really work. The land market is a huge mess. So I might have a complete deal that this land is going to be sold, but the money might come in after 2 months. Okay, now I made up my mind that I want to buy shares, but the money is going to come after 2 months. So I can't pay for the shares right now. Okay, now in that situation, I am at a risk, because if in those 2 months share prices go up, then I've lost an opportunity to buy shares at a lower price. Is that a fair statement? Okay. This is exactly like the opposite, where I said that I had shares when I was worried the share market would go down. Here I'm saying I have money, or I'm expecting to get money, but I'm worried that share prices will go up by the time I'm ready to actually buy the shares. Then I'll feel foolish and I will have lost opportunity to buy shares at a favorable price. So what you can do is, you can buy shares at a future date right now. How? By entering into the futures market. Okay, so you go into the futures market and get into a long position on the Nifty futures right now. So if in the next 2 months the Nifty price goes up, then you will benefit from that upside because your futures position will pay you. It's as if you've bought a lot of the shares now. Why is this advantageous? Because you don't need to put up the full money right now. Okay, the initial margin that you're likely to have to put up on the Nifty futures market is probably 6%, 7%, 8%, something like that. So if you want to take a position of 1 million rupees, you might need to put up collateral right now of maybe 70,000 rupees, 75,000 rupees, some such number. So you're only posting collateral of 75,000 rupees. You might get to take a long position on the futures market of roughly 1 million rupees, which is nice because you don't have to put up the full money right now. And 2 months from now, when your money comes, you can convert this into a full position where you actually buy underlying shares. Okay, so this is also hedging, because you are expecting that money will come in the future. You have made up your mind, you have decided that you're going to buy shares, and you are eliminating the risk that share prices might go up and you might stand to lose. Okay, it sounds a little non-obvious, but it is exactly like having shares, shorting Nifty. Have money, long Nifty. This is hedging. Okay, with this we are finished with all hedging applications. Now let me turn to speculative applications. This is very easy. Speculation with the index futures is extremely simple. You feel that Nifty is going to do well in the future, buy Nifty futures. You feel Nifty is going to do badly in the future, sell Nifty futures. Okay, that's all there is to it. If Nifty goes up and you have a long position on Nifty futures, you will make money. If you have a short position on Nifty futures and Nifty goes down, you will make money. If you have sold Nifty futures, if you have a short position on Nifty futures and Nifty actually goes up, you will lose money. Okay, so this is very straightforward. There's nothing great. It's just like right now we do speculation on Reliance or ITC. Okay, I go to NSE and I buy Reliance, thinking that Reliance will go up. If Reliance goes up, I'll make money. If Reliance goes down, I'll lose money. That's all very straight. There's no complexity. The only subtlety that we should be very cautious and very knowledgeable about is this difference. today we are all used to doing speculation on individual shares. So I think that ITC might go up, so I buy ITC. When you trade the Nifty futures, you're taking a bet on Nifty as a whole. Okay? You're taking a bet on overall macroeconomics, on the overall political scene in the country. You're taking a bet on macroeconomic outcomes. Okay? You're really taking a bet on what will happen to Nifty as a whole, not on an individual stock. You should be conscious that that is different from what all of us have been doing right now. But for the rest, there's nothing complicated in how you implement these positions on the market. Okay? So let me reiterate, as the slide says, that today in India we don't have index futures. Now I have met many people who say that ITC makes a good index proxy. Okay, and the reason is very simple, that out of all the Nifty stocks, ITC has the highest correlation with Nifty. So I know many people who, when they think that Nifty is going to go up, or there's an overall broad market movement that they expect, then they like to go to NSE and buy ITC. Why? Because there are no Nifty futures. There is no tradable index product. So people are using ITC as a Nifty proxy. Okay, that's fine. We're doing that right now. With index futures, you would have a very clear choice that if you want to really take a view on the index, then you would be better off trading the Nifty futures. Whereas if you want to take a view on a stock, if you have a view about ITC, then you could take a bet on ITC. There will be two different alternatives. Right now we don't have this. This is all messed up. That we don't have a clarity of, are you doing stock speculation or are you doing Nifty speculation. But once the index futures market comes, you have a very clear choice that who am I today? Do I have a view that Hindustan Lever is going to go up, or do I have a view that Nifty is going to go up? I have to make up my mind on who I am. Okay. Now, suppose you have a Nifty futures. Now today you are used to buying ITC or selling ITC when you have an index view. When you have Nifty futures, and if you have a view about Nifty, then you are obviously better off implementing your position using Nifty futures. Why? Because if you instead buy and sell ITC, you are actually paying a lot of the unsystematic risk. Right? There is the epsilon of ITC. That sometimes the position on ITC might move in some awkward way because of news about ITC, not about Nifty. So if you have a view about Nifty, you are better off trading on Nifty futures and not on ITC. Conversely, if you have a view on ITC, then you should either do long ITC plus short Nifty or short ITC plus long Nifty. One of the two ways of implementing stock speculation plus hedged away the index. Okay, see that's what I have here. That you can either be long ITC plus short Nifty, or you can be short ITC plus long Nifty. These positions make sense. Okay, but the most interesting is my last point on this slide. That if you are just naked long ITC, frankly that doesn't make any sense as a speculative position. If you are naked short ITC, it doesn't make any sense. There is some logical confusion. If you have index futures and you believe ITC is going to do well, then the only sensible thing that you should be doing is long ITC plus short Nifty. If you have index futures and you believe Nifty is going to do well, the only sensible thing that you can do is to buy Nifty. If you have index futures, it doesn't make sense to be naked and only do long ITC, which is what everybody is doing today. And that really illustrates why we need an index futures market, because today the positions that people are taking are really very awkward. It makes no sense to be long ITC alone. Either you should be long Nifty or your long ITC should be supplemented with short Nifty. Both those are logically sound. It's logically incorrect to just be short ITC. It doesn't make any sense. Okay, with this I have finished with all the hedging and the speculative applications. Now let's turn to the last area, which is arbitrage. Okay, the first kind of arbitrage is money lending. Okay, this is what we talked about in the context of futures pricing also. What is money lending? I am putting my money into the market to buy shares. Normally when I buy shares, I am exposed to the risk of the fluctuations of the share prices. So this is not a riskless thing, it's not money lending, it is speculation. Now what I do is back to back. I buy shares today and I contract to sell them at a future date. Okay, so it's like I've got a forward contract to sell the goods which I bought today. So I buy goods today in the spot market and I simultaneously sell them off on the forward market, on the futures market. So on net I have no exposure because I have got a guaranteed fixed price at which I'm going to sell the goods at a future date. Is that correct? Okay, so overall I'm taking no risk at all because I bought the goods and I sold them at a future date. So I am not vulnerable at all to the movement in the price. Now all that I capture is the difference between the spot price and the futures price. Okay, that difference is called the basis. So if you see that the Nifty spot is at 1200 and the futures are at 1250, then you're going to get 50. Okay, whether that's an attractive rate of interest or not is your question. It might be, it might not be. But if you do what I call a stock repo, it's really a money lending transaction where you're putting in the price of the spot right now and you're getting out the price of the futures at a future date. And there is a clearly defined holding period. There's a clear date on which the position will unwind. Okay? In this you will capture the basis. The difference between the spot price and the futures price is called the basis. Okay? So this is called money lending. It's also called arbitrage, but it's basically a stock repo. The opposite of that is stock lending. It's what I described as reverse cash and carry when I talked about futures prices. In this, I have all the shares of the NSE 50 index in the correct proportions. I go to the spot market and I sell them off. Now I'm exposed to risk, because if I go to buy back those shares, I might be exposed to price fluctuations. So what I do is I simultaneously contract to buy back those shares at a future date by buying the index at a future date. So I lock in on the price. Again, this is a stock repo, but I'm getting rid of goods today, but I'm contracting to buy them back at a future date at a fixed price. Suppose you see that the Nifty spot is 1200 and the Nifty futures is 1250. Now there are two cases. Either you can come into the market and say, I want to lend money at this rate of return. Okay? That's when you do cash and carry arbitrage. So you come with money, you buy the shares and you sell them off at a future date. You will capture the 50 or 50 will come into your pocket. Alternatively, you say, this is an attractive interest rate, I want to borrow at this rate. Okay? So what you do is you sell off the shares today and you buy them back at a future date. You've got the funds right now. So you will get 1200 rupees in your hand right now and you will have to repay 1250 at a future date. Okay? So this is the reverse cash and carry end, where you're really able to use your shares as collateral and you're able to borrow money from the market. In summary, I've got 8 applications of the index futures market. You should have all these by heart. Okay? Ponder each of them, make sure you understand each of them, make sure you have them by heart, make sure you really have an intuition into each of them. If you understand these 8 strategies, you're ready to go use the index futures market. In a futures market, you will have many different prices. Like let's take, for example, I have a gold market. Now, there is a gold spot market. If I go to the secondary market and I try to buy gold, there is a price of gold on the spot market. That is something which we call the gold spot price. Now at the same time, I can go to the futures market and I can buy gold for delivery on different dates. So if I buy gold for delivery on the